Let's go across to a global expert now, Brent Johnson, joining us live on this edition of The Market. Well, good morning from India. Everything seems to be selling off, even if you see the US Treasury yield, the way it is topping off highest in 11 years. Crypto world, complete meltdown. We've already been seeing what's happening in the equity markets. I guess a lot of it is going to come down to what the US Fed will do tomorrow. 50 basis point rate hike, 75 basis point rate hike. What camp do you fall in?
I think they're probably going to do 75 basis points. It wouldn't totally shock me if they did 50, but I think that they'll go with 75. They've been hinting at that pretty strongly. If they do only go with 50, I think they'll hint strongly that 75 is on the table going forward, but I'm expecting 75 tomorrow.
There seems to be a lot of pressure this time around on the FOMC. US Fed has been criticized for being way behind the curve. We've all seen the outlook when it comes to the kind and the number of interest rate hikes that are perhaps needed to suck out the liquidity from the system. But when you have US President Joe Biden also saying we need to live with inflation which is red hot at a 40-year high, how is the market supposed to see that? Because there was political pressure, one thought, on the US Fed.
Yeah, well, I think you kind of have to take the Fed at their word. I mean, I think they've been pretty clear that they're going to raise rates, and they've been very clear that inflation is now their top concern. And I think you have to take them at their word until they're proven wrong. Now that does. I'm not a fan of central banks. I think I'm not saying you shouldn't question them. I'm not saying that you shouldn't be skeptical. I just think that they've been extremely clear that they're going to hike until something forces them to stop. And as far as them, being behind the curve, I think there's a little bit of a misperception of what central banks do. Central banks are always behind the curve. And the reason they're always behind the curve is they are reactionary agencies. They're not in the prediction business. They're the lender of last resort, not first resort. So they're there to kind of react to what is going on in the markets. And when things get too hot, then they'll try to slow it down. And when things get to going too slow, then they'll try to speed it up. But they don't tip it. They're very, very, very rarely ahead of the curve and almost always behind the curve.
So you're expecting 75. The world is now expecting 75. So what happens then? If we all get what we want, what happens?
That's a very good question. If I knew for sure, I'd be having this conversation on my private yacht in the Bahamas or something. But I think markets are expecting 75. If they come in at 75 or lower and speak not as hawkish as everybody's expecting to them, then I would expect some kind of a temporary relief rally. And I would expect, perhaps bonds to rally a little bit on that, and I would expect stocks to rally a little bit on that. That said, I think it would be a temporary rally. I think equities and risk assets in general will be lower 6 to 9 months from now, into this year, into the first quarter of next year. But I think the most important thing right now is not to be too stuck on any specific narrative. I think investors need to be very nimble, and they need to be willing to be wrong, because I think even despite all that's going on, I talk to a lot of people who just convinced they've got it figured out, that, they need to buy gold, or they need to short stocks, or they need to do this, or they need to do that. And I think it's a very uncertain time, perhaps the most uncertain time, in the 25 years I've been doing this. And so I think, it's very uncertain. It's not necessarily the time to be a hero and, live to fight another day, so to speak.
Now, I know you're not on a yacht right now, but I can see a world map behind you. And I can see some lovely, maps. So if you were hypothetically going on a long voyage where you don't have access to mobile phones, but just before you hop onto that voyage of yours, you're allowed to make one trade, which you would like to keep it open for 6 months or 1 year. Which will be that one trade?
I would buy dollars.
At the current level?
At the current level, yep.
Okay. Really appreciate your time. You've been very frank and you've been very vocal about it. Like you said,
essentially, long story short, I think that we are headed for a sovereign currency and a sovereign debt crisis. And when that happens, I think the most important thing to have is the collateral, which underlies the entire monetary system, which is the dollar. And I know there's a lot of people who don't like to hear me say that. I know it's not a very popular view, But I think it's the most important view. I think if I could own two assets right now in the world and two assets only, it would be dollars and gold. I think we're headed for a sovereign currency crisis. I think countries themselves, not just the companies that are involved in those countries, but the countries themselves are going to come under extreme pressure. And I think when that happens, their currencies are going to lose value. I think citizens around the world are going to lose faith in the central banks. I think they're going to lose faith in their governments. And when that happens, gold typically does well. And I think dollars will do very well versus other currencies as well.
I sincerely hope we don't go there. But after 2008 crisis, all I can say is that never say never.
Yeah, I hope we don't go there as well. This would be one case where I would be very happy to hold up my hand and say, hey, guys, I was wrong. Crisis averted and everything's fine. This is not necessarily what I want to see happen. It's just what I expect to see happen.
So I really appreciate your time and so nice to join us, and certainly hope to see much more of you on ET now going forward.
All right. Thank you for having me.